I think the biggest thing that I want to talk about today is the warehouse automation piece, and when you need to start looking at it. If we take a step back and zoom out and look at the past 3-4 years, we've seen a lot of disruption, a lot of increase in costs. A lot of those are out of our control, right? So clients that we've been working with, they've seen substantial increases, not just in labour but land, and then now even capital, right? So borrow money, your cash rate the highest has been in at least a good 10 years, and it's wild times now in regards to trying to find enough money and to be able to invest in your business, but then at the same time making sure that your investment meets the hurdle rate, while you're trying to manage a slow trade environment. And I think stepping back, like we've seen a lot of disruption over the past, let's say, 4 or 5 years. Out the back of 2019 and into 2020, we had COVID just really come in and disrupt the supply chain for every business globally, right? The you put that into perspective, everyone shut down, changed their business model, shifted online, and then there was a lot of changes to the way that we had to go about business, the way that we could reach our customers, whether that's B2B or the ultimate consumer. And it took us a few months to figure that out, and those who could pivot quickly were able to navigate that and obviously come out the other side. I think now after I think in 2022, consumer sentiment was at an all-time high. No, sorry, a 9-year high. And the biggest thing from that was there was a lot of stimulus from the government coming through. There was a lot of trade happening, so a lot of businesses were buying to meet that demand. And then quickly, as the government had to pull that lever on the cash rate to reduce inflation, we started to see a lot of businesses with swelled up inventory, and consumer sentiment obviously dipped, and trade had to be a lot slower. So a lot of losses happening in the back end of 2022, and then all the way through to 2023. And now we're starting to emerge out of it, where inflation's coming into the right spot, or trending that way. But it's not going to be for a little while until the RBA starts thinking about, all right, we're in the right trajectory. We're talking about cutting rates. That those conversations haven't happened yet, and it's really just on a hold. So the big things about like supply chain is that we know that there's always going to be disruption, right? Whether you've got the war in the Ukraine, now you've got the war in the Middle East, we've got pirates in the Suez Canal, we've got drought in Panama, we've got a flood that's just wiped out the Western Australia rail line. We've got earthquake in Taiwan. Is going to affect our semiconductor supply and the chips, and then we've even got the shipping line that's crashed into the Baltimore Bridge in the US. So what we do know is that disruptions are always going to happen, and how do we go about building that resilience in our supply chain when we can't control those factors, right? Now, every business is going to have a sort of nuanced approach, but one of the things that we're seeing from a macro trend is that there's these supply chain disruptions, which we can tackle with diversification, different inventory planning methods, building some redundancy in the supply chain, being a bit closer to our customers. But if we go down a level, how do we affect some of the biggest trends that are affecting our middle of house, which is like you make, move, sell, sort of horizontal in your business. And a lot of that comes down to the number one factors or top three drivers for automation in distribution centers and warehouses is labor availability. It's a huge problem, and it's not just in Australia. This is a global thing, right? Not everybody wakes up and wants to be work in warehousing. It's one of those jobs whether the unsung heroes, sort of like transport and truck drivers, but it's very it's very crucial to consumer goods supply chains, and any supply chains with physical goods. So one of the biggest caveats that businesses are talking about now is how do we sort of eliminate that trend, because it's getting harder and harder to find the right labour for our business, even though trade as a whole in a lot of different industries and verticals is down. Trying to find that labour is still a big problem. And then you put in conjunction with businesses are now looking for cost out because they inflated their operations based on some strong growth a few years prior, and then now it's how do we increase our throughput, how do we increase our velocity, and volume through the current assets that we have, and maybe even restructuring those our networks so that way we can start making our balance sheet a little lighter, but getting more operating leverage. So that's number two, and I think the new one, which is number three, is very much just about how do we make sure that our distribution, and our supply chain and logistics network in general is meeting the consumer needs and changing, right? Like you know, online wasn't a large part of every business. Although we're in the digital age now and everyone's got some sort of presence, well, most businesses do. It was very online and then bricks and mortar, right? Or online and then your normal channels. However, now it's a blended approach. It's omni-channel, right? And it's not. And if we use retail as an example, retail is just retail, and it's no longer online and bricks and mortar. It's just that the customer just expects the same consistent experience throughout those channels. So the consumers are no longer distinguishing that, right? And a lot of that comes back to the way that you structure your supply chain to execute that promise. And the biggest part where I'm working in at the moment is really about that transformation piece in your customer fulfillment centers and warehouses and distribution centers, right? And a lot of it comes down to businesses don't in this market at the moment don't want to just invest money into something. They've got multiple projects that can yield certain benefits. So capital allocation is a really sensitive and a really crucial topic, and it's now about trying to figure out how you put the best foot forward to make sure that your supply chain is executing that marketing or customer promise, right? And the biggest thing is to make sure that warehouse automation is working, and you're investing the right amount into your supply chain. Is just to start with the discovery piece, and that's probably where people like myself get caught in a lot. Is they know that current processes are manual, or it's the way that you're currently doing things, it's resulting in inefficiencies, and maybe productivity is capped at certain sites. So you've only got a certain sales capacity without having to put on more staff or run additional shifts and that sort of thing. And so there's a case for change there, but being able to quantify that is one thing, but making sure that it aligns with how the business is tracking is probably the biggest part. Like me coming in and looking at a business at one of my clients is it's very much about we do a bit of a retrospective. Let's say the past 3 years, so we can sort of get a bit of a benchmark of where the cost levers are, which ones we need to pull. Depending on the nuance of the business and what's happening, it could be they've reached capacity, or the labor and transport costs are out of control, or a mixture of all of those, plus capacity at the moment for storage isn't there. So what do we do? So we look at the past 3 years just to see where those levers are and where we can try and really pull out the cost levers to really say these are your top three or four sort of cost centers in your business, in your operations. where you're really starting to overspend due to your constraints in your current assets and infrastructure. So we get that packaged up, and we look at your financials. But the big piece, which I don't know if everyone's doing at the moment, and if you shouldn't, this is a call out that you should, is really start looking at a 10-year sort of forward forecast. Now, 10 years it can be fairly long, for some businesses. But the reality is, if you're going to make a substantial investment in your supply chain, you've got to at least have some guide rails to where you're heading. What does that growth look like? What is the price growth? What is the volume growth that you're going to see through your business or all that site? So we get a 10-year sort of forward forecast, and then we can start to play around with how do we, what do we look at, wage growth? Is that, going to be, CPI? Is it going to be, I think for, warehouse workers, it was around just under 4% for increase in wage growth and that sort of thing. But then you've also got, do we buy? Do we lease? Do we use 3PL? And then optimize currently in our current site. These are all the questions that you have to start uncovering, right? And then what's a trade off? So you might lease if you're in Sydney, you might be paying a couple of $100 per square meter for a site that you're about to lease, but you might be able to get a better deal just sending your slow moving or your bulk storage to a 3PL until you get to maybe 5, 6,000, 10,000 pallets, because the cost differential for the lease is and fulfillment for your cost to serve is actually not breaking even until you get to a certain threshold. So these are the things that we start to consider from a finance point of view, right? And then that starts to build up to what's the strategy for the business. So you need to make sure that you're aligning on your future strategy, looking at your product mix, which sales channels are emerging that you're going to want to double down on, or which ones that you want to optimize. And then you've got to start thinking about your current investment appetite. Now, you can build a DC and put automation in, but it's going to cost you above $100 million if you decide to do that. If you can do that, the other parts are you might only want to dip your toe in the water, and rather than go for automation sort of revolution and just change the whole thing and turn it on its head. You might just go, we want to evolve because it's not going to be such a big culture shock and change to the way that we do things, but we want to make sure that we get the right processes in place. So sort of a crawl, walk, run approach. So once you've sort of understood your investment appetite and your risk as well, and that depends on what you're looking at in regards to how much you want to potentially invest, or how much can you invest, what sort of return you're looking for. But then, there's also an element of risk if you don't have the core competency in the business, or if it's outside of what you sort of do. Then there's an extra amount of risk that you have to make sure you get compensated for in your financials and in your return. So the big call out here is we look for the case for change. We review you review the financials, and then you start looking at your strategy piece, right? Where do we want to be in 10 years? How are we going to execute? You reverse engineer it. And then you start developing your short-term and long-term objectives and how this project's going to fit into that. The next part is you need to start. The reason why you need to model out your 10 years is because you need to get an understanding of capacity. And that's capacity of throughput. That's and then that's also capacity, let's say, of storage. And looking at those volumes and doing some sensitivity analysis about, okay, so if we grow 7% year on year, we're going to need this much stock, this much working capital, and we're going to go through this much volume. But if we're going on a more conservative approach, maybe it's 3, 3, 3, then 4 and 5, and then we think we're going to hit an inflection point and it's going to drop down. That's going to be nuanced to your business, market dynamics, and that sort of thing. But I think the big call out here is you need to get an understanding of the capacity that you need from a throughput and a storage and a storage capacity point of view. If you're looking at physical goods for your DC, otherwise you're not going to be able to build your design out to make it worth the investment. So if you're looking to move to a new site and it's a greenfield site, you don't want to undercook it. So that way you've only got 5 years worth of growth when it's a 10-year lease, right? Then all of a sudden you're going to have a whole bunch of costs that you're going to have to incur from outsourcing that fulfillment and storage. And on the vice versa, you don't want to over-engineer a solution where it only works for your peak capacity, and then the rest of the year, you've got a whole bunch of latent capacity in that. It's about finding that right mix. Once that's done, you then sort of move on to your process optimization, and that's really thinking about, okay, this is where we are, this is how we do things, whether it's manual or there's some automated processes or it's system driven, right? But then you start thinking about, okay, what does it look like for the future state with what is best practice, and how can some of the technologies out there help? Now that part there is going to be, that's going to be a little bit fuzzy at first, because we know we want to eliminate as many non-value adding touches as possible. We want to get the best throughput, the best storage density. We want to tick all those boxes, but sometimes there's a trade-off between how much you want to invest, how much flexibility you want, and then how much efficiency that you're going to get, right? But once we put all these together, that's when we start looking at your strategic guardrails, which we call your design principles. Now these act as the guardrails for any sort of project in this space, because we know if it's not hitting your design principles, whether it's maximizing ROI, being delivered simply. It could be making sure that it's a better working environment for your employees, or operational excellence and getting the best throughput and cost out. Now, all those are going to change depending on what your business is after. But those are some of the key tenets that we look for, and that gets developed from your exec team, and then also all the different departments as well input into that. So that way you've got one set of document and a charter to then go, okay, these solutions tick these boxes but doesn't do this, so it's out. And those are the non-negotiables, because once you start getting your design principles in place, then you can start to narrow down what works and what doesn't, because there is a lot out there in regards to automation, in regards to DC solutions and that sort of thing. And I think the biggest part is analysis paralysis, right? So we get caught, I get caught in just to do some quick sprints in regards to validating and ratifying certain projects, because they wanted to make sure, is this in order? Does this tick all the boxes? And if you don't get these guide rails and strategic objectives in place up front, spending all that time in planning in the front end makes delivery of the solution much easier and much more cost effective, because you're not going to have to rework things later down the track, right? I think the other part as well that I touched on just before is that investment and risk appetite. So you got to think about now. You go back 10, 15 years, and it was just a capex sort of investment. You wanted to build a new warehouse or a solution in a warehouse. It's $15-20 million for a medium sized sort of solution, and then that's it. You pay it. You might finance that. But what we're finding now is that those commercial models are changing. So you now get the chance to balance your investment appetite to maximize the ROI that you've got. So it's not always just a CapEx project. It could be a mixture of CapEx and OpEx with a robot as a service sort of function, or it can be fully robots as a service, or it can be a mixture between two, right? So you really want to think about the unique goals and context. If it's design and process evolution for your DC operations, you might want to go into maybe a robots as a service, trial it out, make sure you get the change management right, that human machine interface happening, and you can bed the solution in, because these projects take time. and you don't always realize the benefits of the project from the business case. Like you won't realize them up front because there's always something, these small things that go wrong that you need to iron out before you can get, your workforce operating in harmony with, your automation. Now, there's a slide a slide that I'll put up where essentially the way that we sort of see it is it's sort of like a two-axis sort of thing where we've got low capex on one side, which normally means lower efficiency but higher flexibility. So that's your robots as a service option, or maybe a more flexible sort of approach like AMRs or cobots and something like that. But normally what we find is, and this is normally there would be outliers and that sort of thing. But the rule of thumb is that the more flexibility you have, and the lower the cost means normally the lower the less efficiency. As where the higher the cost and the greater investment means you've got higher efficiency, but you've got lower flexibility. So therefore, you spend a lot of money on a system that's going to have a certain amount of throughput, but it's very standardized. It can't be configured too easily, right? And it might have certain parameters around what it can handle, what it can do. So therefore, but the throughput of it is absolutely blast the more flexible solutions out of the water. So it's really about balancing investment with efficiency and flexibility and what's right for your business. There's a couple of things that you need to consider when you're looking at the automation, and it's very much about making sure that you understand your business as a whole, right? Like it's not supply chain is one of those departments that it's interrelated. It touches everything from you make move sell sort of thing, and it's the engine room for your business. So it's where execution happens, right? For making sure that business consumers get their goods, B2B businesses get their goods, and that sort of thing. So it's pivotal or instrumental that you make sure that you get those parts. You get a really thorough understanding of which departments have to have that input and how the processes interrelate and how that works, because it's going to relate to customer service, it's going to relate to transport, it's going to relate to your people operations, marketing, sales, all those core functions. And if you don't get their input, you don't understand how changing that's going to work. With automation, business systems, all that sort of stuff. It's going to be it's going to become an issue once you start trying to implement. The other things that you need to consider is you need to make sure that there's enough flexibility in automation now because of that point I raised earlier about the changing business needs. Because a solution that you have put in place now may, unless you've got certain volumes that meet that requirement and further beyond, if you're going to have different changing requirements from your customers, it needs to be incorporated so that way there is flexibility. And a lot of the solutions out there do that, but it all depends on the application, the volume, the product mix, the sales channels that you're distributing through, and that sort of thing. So, very key to understand the amount of flexibility that you need. An example of this is you might need to start getting cost savings now, but you're only looking at a 3-year horizon because your lease comes up in the next 3 years and you're going to have to look for something bigger. So you might retrofit something that like a robots as a service sort of option into your current operation, so that way you're only locked in for 3 years. And then once you move, you might be able to get a better understanding of how automation works in your business, and then you can increase your throughput, maybe decrease your storage densities if you get like a compact ASRS or an ASRS put into a new site, so you can reduce that. But there's going to be different approaches and different sort of levels of investment at each stage and what you look for along your journey. I think the other part that needs to be considered is that you need to make sure it's future proofed. So you want to be able to increase efficiency for the future, while also making sure that you can invest further without having any regret spend. So whether that's tech debt, whether that's you don't build too much capacity or over engineer the solution, but you look at implementing as much as you can for certain periods, like again maybe a 3 year period, and then then you can assess 2 years through, and you can go, all right, we need to start ramping up for the next phase because our business is growing. Conversely, it may not grow and it may maintain. You hit a choppy market like we're in now, and you haven't overinvested and you've got a whole bunch of latent capacity. One of the big things about these projects is that they can be really complex, and you want to try and deliver them as simply as possible. So we want to make sure that when we're building processes for these projects or for the systems that we're putting in, that we're optimizing the processes to reduce as many touch points as possible, and that way we can make sure that the system can be as simple as possible with its logic, so that way you don't need to rely on changing the entire configuration to be able to adjust to certain requirements, and that's probably a key tenet as well. And I think the big part is with a fluctuating market that we've seen over the past few years is that we need to be able to make sure that we can scale the solution. So everyone's what wants to grow. You want to be able to build it to a certain point and then scale afterwards. So making sure that there's enough scalability so that way it can meet your intraday logistics. So the peaks and troughs within the day, but then also the peaks within your current sort of seasonal trends, right? So if Christmas, if the Christmas period, or let's say Mother's Day or Black Friday is a huge peak period for you, you need to make sure that your system can cope with that. Now, you may have to reduce, customer lead time so that way you don't, or increase customer lead time so you don't over-engineer the solution. You don't want to be building to, your highest peak and then have that as the design point. Then all of a sudden it's not running to full capacity, because then you're not going to be able to get your ROI then. Those are some of the conceptual approaches to supply chain automation that a lot of businesses need to look out for. I think the biggest takeaways here is that we know supply chain disruptions are going to happen. We know that we're going to get gluts of inventory, port strikes, container ships, shipping lines getting consolidated, all the way through to labor availability constraints, and then with all that sort of stuff in mind, what can we control? We can control what happens in our shed. We can control, somewhat if we own our transport fleets and that sort of stuff. So, if we sort of zoom in on the things that we can control and making sure that we build them with the future in mind, looking for, flexibility, scalability, and making sure it's simple as possible. Those are the real key things that we need to look out for. But I think all of it needs to start with, really strong discovery in the business first. And then, making sure that once you've done that discovery piece and you understand that there really is a case for change, is detailing out those design principles, so that way it's a no-brainer. When a solution comes across your desk, you can go, all right, this meets these design requirements or design principles and strategic objectives. It doesn't tick these, so it's a no. It's a no from us. That's some of the key things that I think that need to be taken into consideration, especially now with all the different options available.